Everybody, this is Dr. Flight. I hope you're doing great today. We're going to have we'll talk about portfolio management. And so when we look at product portfolios, my favorite way to think about these would be to reference products as investments. And when you manage a collection of products, you're managing a collection of investments. And so investment portfolios would be something that you might be familiar with as an investor, or if a company has multiple financial investment instruments that they use to generate income, or projects for that matter that are invested in, and then there's return on those projects. You can think of them very similarly in respect to portfolios of products. And so that's why there's a nice little analogy that can be made when you think about managing risk and reward and some of those types of things. What type of cash flows are going to generate from an investment translate nicely in a lot of ways to how we think about products. And just like with a portfolio of investments, you want to balance multiple investments at the same time with your tolerance for risk and kind of the goals and outlook of the organization overall. And with products, we do very similar things as well. So we're going to look at a couple different models here as we look at portfolio analysis when it comes to products. And oftentimes, following the product market motif, you can think of balancing and kind of managing, if you will, products at kind of in the context of the market and also in the context of the industry or the product space, which would be the competitive landscape. So we'll just kind of look through a few examples here and kind of go from there. And my first example offered is Apple. And if we look at a couple different products that Apple has, the watch, iWatch, and then also traditional Macintosh computer. So we have two different products, but owned and operated and conducted through the same company, Apple. And think about now the computer space and the market attractiveness for computers versus the market attractiveness for watches. Now, one way among many we can look at this would be through what we call a product life cycle. And if you look at the chart down below, we look at sales or demand for a particular product and how that deviates and changes over time. The product life cycle is a curve. And look at these two products. Think of the iWatch as something that's fairly early in the product life cycle. And, this is going to be a smartwatch technology, and it's probably further along in the product life cycle. It may not be in the early growth stage, but it's probably in the late growth stage in terms of product categories. The computer, Macintosh computer, whether it's a desktop or even a laptop, is going to be well into the maturity stage by now in terms of where that is on the product life cycle. Now, if you're Apple, again, you operate in these two different product categories. And importantly, the goal here is to recognize that the way we manage these two products within our portfolio of products will be different. We're going to use different methods and kind of processes, and the way we're going to look at how we're going to grow these products or manage them at least will be different because they're in different points in the marketplace in terms of product life cycle. Now, simultaneously, we can think of these two products as, again, components of a portfolio, and think of them perhaps in the context of market position or market share, which might be a nice representation of market position or competitive position. The iWatch has a very large market share, and again, it's early in the product life cycle, so high market share. The Macintosh, the computer, has a very low market share because it just always has. It's because of the nature of the operating system and and other factors. But in the computer space, Macs don't take up a very big percentage of the market. So again, we want to manage these differently because of kind of where they are in the marketplace. We probably think of these Macintoshes as cash cows or mature products. They're if you use the Boston Consulting Group matrix, you would call them a dog technically, but they're probably more of a cash cow in reality. The iWatch, on the other hand, again, if you were using the BCG Growth Share Matrix, which is a popular tool to use in portfolio analysis, that's the iWatch would probably be a rising star as in terms of its categorization, as high market share and a lot of potential in terms of the product category. And given that we're into multiple generations of the product, we're probably looking at early stages of maturity for that particular product. So maybe a cash cow, but certainly a star or cash cow, as compared to a cash cow or dog that the computer would likely be if you were using that same type of language or model called the BCG Growth Share Matrix. A couple other kind of just illustrations here as we look at this. There are two different companies or organizations, if you will, that are depicted here in the product life cycles on the left and on the right. And we can kind of say that portfolio A, which would be maybe company on the left, look at their products along the product life cycle and kind of the different points in time that are designated here. We see all of their products, A, B, C, D, and E, all of these products are sort of bunched together towards the maturity stage and a little before and a little after. And think about products at this point in the product life cycle are very stable. We know exactly what's going to happen with them. There's not a lot of uncertainty. The market understands what the product is. The competitors who are going to enter the market for for products at these stages have already done so. So again, this type of company who has a portfolio of products that are all grouped together like this is probably going to be not very risk loving. They'll be risk averse. They'll probably be looking for very stable, mature returns on their product investments. Now compare that or contrast it, if you will, to the portfolio B, the company on the right, and they have products that are spread out further on the product life cycle. But also they're all before, or they all happen, or they're all in stages prior to the middle of the mature stage. They're not any products in the decline stage. And A, you could probably argue, is in the early phases of the mature stage, even though it says mature market and kind of is delineated there. But the point here is that the portfolio of products for portfolio B suggests a company that's much more innovative, much more willing to take risk, much more willing to see about new product investments and things like that. Remember, products in the early stages of the product life cycle, there's a lot of risk associated with these products because we really don't know what's going to happen entirely. This product E has gone through the early stages of the innovation stage and the introduction stage. It's in the very early start of the growth stage. And honestly, competitors could come in, they could lose, the product could ultimately fail. We really don't know what's going to happen. So at any rate, that's a very risky type of thing. Now, let's just take this portfolio again and let's sort of flip it on its side a little bit, if you will. We're going to look at some other products, but we're going to look at this left and this right, and there's a lot going on this sheet here. I get that, but on the left we have that product life cycle, but it's rotated. Okay, so let's just sit there a little bit. Just look at that rotation. So the top part of it would be the early stages and introduction stage. The bottom part, down towards the bottom part of that illustration, would be the end of the product life cycle, the maturity and decline stage. And just kind of map over, if you glance over to the right now, you can sort of map over where the market growth rate would be. And again, early on during the introduction stage, that growth rate is very rapid. It's it grows very quickly. And so you see the high 30, 25, 20% growth rates that would map over to that early stage product life cycle. As the product life cycle continues on, it goes down the page and goes down in market growth rate as well. Okay, so the market's not growing as fast later on in the product life cycle as it is early on. And now we look at this 2x2 matrix where we have growth rate on the vertical axis, and on the horizontal axis, we have some type of measure of competitiveness in an industry. Now, the Boston Consulting Group, the BCG Growth Share Matrix, specifically uses market share as the metric or measure for the horizontal axis on their chart. And if you'll remember that model, products that are in the lower left are going to be dogs. They're going to be low on market share or competitive position, and it's going to be in a low growth space. So that B product, while it's not low on market share yet, that it's probably heading that way or could possibly be heading that way. We might want to begin to divest. It's probably in the decline stage. Or it's in the late maturity stage is where it is. The A product, lots of market share, but it would appear as though the market growth rate is not particularly fast. It would suggest it's in the middle or late phases of maturity. It's probably a cash cow type of a thing. The C product there, again, probably towards the middle of the maturity stage. We don't have a huge market share in that, but we do have, a sizable competitive position based on that kind of range down below. So we probably want to grow that into an A. We want to move that over. E's and D's, those two products are very likely products that are in the very early stages, and we want to do a lot to grow them. We want to invest in money because those are in the growth stages, and we're defining the market, and we're doing some things like that. So again, kind of think about, if you will, the idea of mapping from the product life cycle. The position of products on it over to a model called the BCG Growth Share Matrix. Now also think about strategies and ideas that we want to kind of think about as we're moving, wanting to do things. So again, product A, slow growth near full share development, probably in the maturity stage. B, kind of in the decline stage. We're probably going to divest that. Product C, 10% growth rate for C, 50% share though. And so late growth stage, early maturity, things like that. That's kind of where we are. Now, as we look at all of these, think about how we're going to manage each one of them as a group or as a set, right? So product A, defend, continue to invest in the sense that you want to retain customers and maintain customers, but this is not going to be a growing market. So we're not going to go out and find new customers per se. We want to keep the customers that we have. We want to keep them loyal. Probably want to try to get more consumer surplus out of them if we possibly can. Again, B, we're going to do something called harvesting or divesting, most likely, get rid of those eventually. Milk as much money out of them as we possibly can. C, grow that into an A. So there's still a lot of market potential there, most likely, but it's going to close up quickly. So we want to grow it while we can, and then we want to secure those customers. Try to move them over to be the new A. A is eventually going to be a B. B is going to eventually leave. C is eventually going to be the new A. D and E are kind of interesting because with D, we don't have a lot of share. We don't have a strong competitive position. So we need to look at how we can strengthen our competitive position, and see if we can't be more, whether it's attribute based, benefit based, something along those lines, and see if we can't try to generate a little bit more market share out of that while it's still a growing product category. E, we want to maintain our share. We want to defend against competitors, and we want to build and move it into a cash cow. So all of these different strategies kind of come into play, and again, we can kind of see illustrations of this in real life, where this happens from time to time, right? We want to drop products, we want to add products, and we want to see if we can't grow and do some different things like that. So here's some quick illustration with Yum Brands. Again, from the early 2000s, early to mid 2000s. The Yum Brands is a collection of restaurants that would include KFC, Pizza Hut, Taco Bell as the big three. They also previously owned Long John Silver's and A&W. And if we look again at the chart, we have the vertical axis opportunity for growth. So this might be the growth of that product category or growth in general. And then segment would be market share, or segment market share would be down below in the horizontal axis. And so in the pizza category and in the chicken category and the specialty Mexican food category, all three of those illustrate opportunities to grow. Now, Pizza Hut and KFC represent by size. See, the size of the circle suggests they're very large revenue generators for this organization. A&W and Long John Silver's, on the other hand, don't offer as much growth opportunity. Even though Long John Silver's, this is a company that they have a lot of market share in the seafood, fast food, seafood space. But A&W, they don't. So question you could ask is, well, what should we do? How should we kind of move these and grow these? In this particular case, as the illustration provides, divesting A&W and Long John Silver's is a method or a strategy that helps you focus and really clearly view the market spaces on the ones that are important. So getting rid of those two brands allows Yum to focus more energy on the brands that they're doing well for them, and it also helps them perform better. So you can look at the performance in revenues and profit through the years. 2011, they dropped these two products or two brands. Revenues actually go up. Operating profit goes up. Operating profit as a percentage of sales. While it's a little softer, they're more efficient in terms of how they're doing things. So freeing up cash that they were otherwise spending on A&W and Long John Silver's was a good thing to do. They could take that cash now and invest it in their other brands that are doing well. Okay, so kind of think about groups of products simultaneously and how they, while they work independently of each other most of the time, a lot of the time, it could be the fact that as you're shifting resources around, you want to shift your resources to the investments that are going to yield you the greatest possible long-term outcome. And this is exactly what happened in this case. Okay, now moving forward, I want to offer just a summary, if you will, of some different strategies that again, as you're viewing your portfolio of products and how you want to grow those or how you want to manage those to maximize the health of the firm, oftentimes we think of growth opportunities as offensive minded or taking advantage of opportunities during the growth stages, where that strategic focus might be investing in growth. Whereas when products start to shift into the late growth stages, maturity stages, and decline stage, then we want to assess the market that we have, assess the customers and the loyalty of the customers, maintain and protect those customer bases while defensively positioning ourselves against eroding market share, maybe competitors who are out there, and some things like that. So we'll actually have a number of different offensive strategies and then some different defensive strategies. So we'll look at kind of these in terms of each at a time and just kind of walk through some of these and just talk a little bit about how we might think offensively or defensively depending on the type of products that we have. And our goal here is to impact organizational performance outcomes like share performance, how much market share you control. When you control a lot of market share, it helps you when you are thinking about like channel management and managing external relationships with distributors and retailers and some things like that. So certainly being a leader and share is important, but also obviously sales growth, sales revenue, unit sales growth, and our profitability. Balancing costs with price and how much revenue we're bringing in versus how much it's costing us to produce that revenue from a profit perspective. Right, so there's three different kind of major concepts with business performance that we want to ultimately kind of impact. And so we'll kind of look at this from the offensive strategy perspective first. And there are three core strategies, the first of which is to invest so that you can grow sales in existing markets. Now, this might also be thought of as a penetration growth strategy, and that would be from the Ansoff growth model. But invest and grow so that you can grow in the market space. So continue to advertise, continue to promote the product, right? Awareness campaigns, and potentially investing in new products. Awareness campaigns, doing promotional activities, doing activities that's going to grow product sales within existing markets is probably the safest thing that we can do of all the different growth strategies or strategies that are out there. Aside from defensive strategies, it's very safe to be able to do that. Okay. Investing to improve competitive position. Right? So direct competitive positioning suggests how we are located on the perceptual map, for instance, relative to our competitors. So think about those features or product benefits that are most important to the customer and the ones that our competitors do particularly well that we could do better, we might invest in. We might put money into that so that when the customer looks at our products and our competitors, they'll view us more as equals as opposed to seeing where our differences lie and noting that our competitors outperform us in certain parts of the product. We want to up our game on those types of elements. And so investing in those types of things would improve our competitive position. We might also improve our competitive position again by being more aggressive distributing our product. We might improve our competitive position by lowering or managing our pricing strategy. So changing our price to match our competitors would do this as well. So there's a number of things that we can do from a marketer's perspective, changing price, relocating the product, from a distribution standpoint, changing the product benefits. And those are all things that we can do that would bring our product, again, perceptually much closer to our competitor, and we would look to steal market share and get market share from them by doing that. Okay, the last one is investing in new markets, finding underserved yet profitable groups of consumers that we might be able to go back and reach. We might be able to identify and see if we can't find new consumers who would buy our product. We might find consumer markets that are never been reached before. These could be international markets, or they could be markets in the domestic environment that just simply have been overlooked. Consumers that we haven't really focused on before, or that the industry has not focused on before. Now, again, this is sort of moving into niches or smaller target market spaces. Can be expensive to do, but again, you're being aggressive in identifying who these underserved markets are and seeing if you can't create plans that will target them specifically and offer them opportunities to buy your product. Okay, so these are the offensive strategies. Now, one of the questions that comes up, and this is going to be kind of in between offensive strategies and defensive strategies, and that's why I'm kind of talking about it now. This idea that, statistically speaking, over time, a great majority of companies experience periods of time where growth stalls. Now, our goal is to grow year over year. Our compound average annual growth rates, for instance, are important, and we want to know that each year we're on average gaining, 5, 10, 15% growth rate. So the question is, what happens when we hit the wall and growth declines, or at least slows down, or maybe stagnates and stops? Statistics, again, suggest in a study that was conducted, 435 out of the 500 Fortune 500 companies experienced a stall or a stoppage of sales growth over the past 50 years. So over the long haul, over a long period of time, the probability of your company hitting a stall is very high, over 87%. So what happens? What do you do when this happens? And what are the ramifications of this? So here's again, just kind of following the flow chart kind of from this one study. 87% of companies experience stall. Those are high performance Fortune 500 companies, right? So the rate's probably higher for non-Fortune 500 companies, I would guess. But at any rate, 80%. Now, of those who have stalled, we can kind of look at this idea that their growth after, kind of like, or growth before, was it slow or negative growth? 54% had actually, kind of stalled out and gone negative, which is kind of scary in and of itself. While other companies within that 87% continued to grow some, but still saw a decline. They still didn't achieve, didn't stay where they needed to be. Of that group who slowed down the most, 67% eventually went bankrupt. So 67% of 54% of the 87% ultimately went bankrupt and could not recover from the stall. So what does a stall look like? We see growth going up and then we backtrack a little bit, right? Starbucks is an example of this. And so over time. 2005, 2006, we see growth, growth, growth. And to be honest, or to be fair, a lot of the growth that is there was from new store growth. So what happens is like in this case, you have so many locations, and then each year you add new locations. Every time you add locations, it adds growth, right? New sales from new growth. One of the things that we don't look as carefully at is sales at existing stores year over year, as opposed to sales overall, because sales overall takes into account the new locations, and that overinflates true growth. It overinflates the true growth of what's happening. So when you see 2005 through 2008, that's exactly what's happening. Those growth figures are being artificially inflated because they're adding so many more units every year. So what happened was 2008, 2009, fewer stores were opened. They closed stores. They had to retrench a little bit to kind of take back, and then that allowed them to become more focused on their existing store sales. They came out with new products. They came out with new beverage lines, but also more importantly the food lines and pastries and some things like that were offered there as well. That bumped them up, kind of to come out of that stall. So that stall was very short-lived, right? That wasn't a very long stall at all, but it illustrates kind of this idea of being aggressive with your products and how that works. So coming out of a stall, precursors to the stall, things that happen in advance. Being uncompetitive in your cost structure. So even though you're making a lot of money bringing it in, your costs are going up and your costs are not sustainable. Reduced return on investments, some type of distress or financial distress from debt. Debt will cause financial distress. The cost to carry debt and to pay debt off is tremendous. And so companies that don't manage that particularly well will face cost issues that they can't overcome. Economic downturns, attempted takeovers, consumer decline, consumer market decline. Those are all indicators that a stall is forthcoming, and can be predicted. They can be used to predict dangerous times ahead. So a couple things we can do. One, shifting from defense to offense. Now, this might be contrarian, but the idea is if you are in a stall, it might be that you are too passive. You're not aggressive enough. You're too lackadaisical. And by putting the pressure on the gas pedal, you can push yourself by creating new markets, creating new products, and moving forward. Again, this may be contrarian. Some people may think, well, look, we're in some financial distress. Now's the time to save money, to be conservative. And that would be a retrenchment strategy. And that there wouldn't be anything wrong with that, but that's not always the right thing to do. Sometimes you have to spend your way out of trouble. I know that doesn't sound like it should happen, but that might be the course of action that's best. Now, the retrenchment idea, though, is where you take away products, take away brands, take away elements of your business to focus better on what you're doing and what you're doing well. So the example earlier with the Yum Brands, where they took away a couple product categories, A&W and Long John Silver's, that was a retrenchment strategy to be able to refocus their energy on their core products that they do particularly well in. And that could be how you get out of that stall as well. Another example for General Motors, exact same type of an idea where, and they've done this over the years many, many, many times, but discontinuing some brands that they feel are unsuccessful. In this case, now this example is way back 2009. So we had new electric car Volt technology that was new. They were putting a lot of money in to invest in to grow. But then later on, you look at the product life cycle of all these other brands, Buick, Cadillac, Chevy, GMC, and those, they felt like those were their core products, and their other brands, Hummer, Pontiac, Saab, and Saturn, they were ready to divest in order to save money and costs that they were expending servicing those brands and put them into other products as well. Since then, they've managed a whole bunch of other changes as well. So the idea is drop brands or drop product categories or products that seem to be holding you back or causing you to focus in too many directions at once. And that'd be another strategy to do. Again, kind of illustrating their kind of profit, their move over time. We look at 2008 or 2006 down, 2007 if you look at operating income over time, and then this is compared to the effectiveness of marketing, and then also marketing's ability to return profit. These are these two charts, and if you start in the upper right, 2006 down, 2007 down, 2008 down, 2009. They dropped those, they divested in those products after 2009, and then 2010 comes along, and right away they're able to, show stronger financial performance, return on investment, the marketing efforts they did, and so forth. All right, so yeah, this is like short-term little micro changes that you want to make, but if you can tell that a stall is coming, it's you can be proactive to either be more defensive, take a retrenchment perspective, or potentially, depending on the layout of your product array, if you're not very stretched, if you don't have a lot of product categories or big product portfolio, you could actually hit the accelerator and grow those to get out of the stall as well. Okay, so again, this is kind of the in-between thing. We'll talk about some of these defensive strategies. One would be simply protect your position, improve service, improve your loyalty programs, try to get as much, again, out of your consumers without losing them. Retreat to serving them well by protecting your position in the marketplace. So this is a consumer thing as much as anything, but it also could be like you have a position carved out in your perceptual map space, like maybe your key things you do well, key things your product does well. You want to protect those. You want to defend that you are the one who does that. If you are a company and you're known for great engineering, great engineered products that are made well, then you want to focus on that, and that needs to be who you are. And in fact, you want to be known as the best of that trait, and so you want to advertise that and promote that to protect that space that you've created for yourself. So protecting. Optimizing is another method that we can kind of think about doing. When we optimize, we want to use our resources and our funds as efficiently as possible. Okay, so we want to focus then on making sure that our media buys, the money that we're spending, the types of things that we're doing for product development, all of these types of things are done efficiently, that we're putting our money where they should be, they should be put, and capitalizing on the fact that some markets are outperforming others and moving emphasis and resources towards those if possible. So we mentioned on the list of things to do here, repositioning. So we might find some market segments that are more profitable or moving a little faster, growing a little faster. And if we get stuck in a market segment that's slowing in growth, then the time is to move to a market segment that's a little bit faster. So repositioning funds, those types of things are things we want to do very likely in that scenario. When we talk about other defensive strategies, what we'll probably want to do is begin to harvesting products, and kind of the end game for some products is when we stop or slow down investing in those products, and we kind of let them run their course without trying to reinvent them. So one of the misnomers is that products in the decline stage, we want to get rid of them. And the reality is, just because they're in the decline stage, it just simply means that fewer new people are buying the product, or fewer sales are available to be made. But sales are still being made, and the product is the most profitable in a lot of ways than it ever has been, because you're reducing your costs. So as you reduce your costs to support a product, you're still selling the product and making money. So that harvesting strategy is very, very important. It's the one that I really want to emphasize here as a defensive strategy in this category. Okay, so generally speaking, when we look at this, think about being aggressive in the marketplace or being defensive in the marketplace. Either taking care of your niche and your space and your perception of who you are, or branching out and trying to define yourself as something new. So in some cases, those are very offensively minded concepts where you're going out to try to do new things, new products, new markets, looking to be aggressively competitive to take market share from others. In the other case, we're trying to be protective of our market share. We're trying to shield our customers. We're trying to regroup and kind of focus on the things that we do well, as opposed to pulling ourselves too thin and trying to do too much at once. Okay, so both philosophies are used depending on kind of where that product is in the product life cycle. If it's early in the product life cycle, we're oftentimes much more focused on offensively minded activities, whereas if it's towards the end, in the middle or the end of the product life cycle, we want to be more defensive. Okay, so there's a lot in this video. There's a lot to digest. Hopefully you have a chance to pause the video when you want, but at any rate, thank you for touching base, and if you have any questions, please let me know.